To welcome you all to the Daily Energy Markets podcast. It is the first trading day and first trading week, actually, of the fourth quarter. So probably a very significant period ahead for us. Delighted to be joined today by three of our regular experts and commentators. Ammar Najia, Global Head of Derivatives, BB Energy. Let me start with you and let's get an outlook from you for the next 3 months. You know, we've seen obviously prices rise 25-30% in the last quarter. Expectations for the next 3 months ahead from you.
So Vandana asked me the same question last week. So 110 Brent going into the end of the year, so higher. I like commodities higher. I like oil higher. And I think, since the market rallied late June from $67 basis WTI, everybody was pessimistic and, oh God, and all this kind of stuff. Market has done nothing except go up. And right now, I think we're in the skepticism phase, as in, it's gone up so much, it's bound to come off. So I'm looking for another leg higher, a substantial one at that.
Okay, and what will drive that higher? I mean, is it just technical sort of gravity or other?
No, what drives it? No fundamentals. I mean, market goes up doesn't magically mean that demand starts to emerge out of nothingness, and doesn't mean that supply also disappears into nothingness or emerge or whatever. So markets, I believe, are driven by sentiment. So what's going to drive this is basically people being short, people being skeptical, people thinking that a recession is coming, people talking about China and you should sell and all this kind of stuff, and pushing the market up and getting them to panic and buy. So I think that's what's going to drive the market.
Okay, Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters. Welcome again, Clyde. Would you agree with Ammar in the sense that the momentum is still upwards from here? I mean, we're already at $92 for Brent. He's calling it to go above 100 in the next few months. Give us your perspective on the influence from Asia on that, obviously, as a big demand center.
Well, I might have a slightly different view. I don't discount the possibility that oil will go above 100. I mean, that's always on the cards, as long as the Saudis and the Russians and the rest of the OPEC plus group maintain those cuts and really do take barrels out of the market. But I think we're starting to see those early signs of a little bit of demand coming off in Asia. It is a top importing region. And the huge X factor is always China. In the past, when oil prices have risen as sharply as they have, you're now looking at like 36% since the end of June. What the Chinese have tended to do is dip into their stockpiles. Now, what this means in practical terms is if they choose to, they can go from importing about 12 million barrels a day down to about 10, while still running their refineries as hard as they currently have been, and therefore still being able to capture all those lovely diesel profit margins that you're making in Asia right now. So that would be the sensible play for the Chinese to do. Lower their import bill, but still make a huge amount of money on the exports. So I think you're starting to see that. We have seen Chinese imports go down a little bit in September, but you got to remember that the way that the market works with the lags between when crude is arranged and when it's actually delivered, you wouldn't actually really expect to see their imports come off, if they are going to come off, until October, November, December, because that's when they would have been buying the more expensive oil. So I think that's the X factor at the moment. I will defer how I feel until I actually see what the Chinese are really doing. Anecdotally, we're seeing them starting to lower imports, and I think that might just put a cap on oil prices. Not saying it's going to drive them lower, but it will be pretty hard to get over $100 a barrel if the Chinese, take away 2 million barrels of demand.
Yeah. Adi Msirovic, Director of Surrey Clean Energy. Good morning. Welcome. Good to see you again.
Morning,
Let's talk a bit about the factors that could bring cap oil at $100 at least, or keep it below. One is actual natural demand coming from China, for example. The other one, of course, is the proactive, unnatural activities of OPEC, supporting the price through fundamentals, but through sort of proactive action. And supply. I mean, a lot of people now saying that, hang on, it's time for OPEC to slow down a bit. We're getting towards $100 a barrel. this impending recession in the US is coming next year, albeit shallow. They meet later this week. The panel meets later this week. Do you think anything will trigger them to change their policy ahead of December?
I don't. I'm not sure that they will change very much. Actually, I think Saudi Arabia is quite happy with these prices. In fact, I would guess they would want to see prices a little bit higher than that, even without admitting it. The key reason for me thinking that is that we've got the news of Saudi Arabia coming back again to the international markets, financial markets, to actually plug their budget deficit, which is appearing again. So for end of this year, next year, we're expecting some 2% budget deficit again. So I think they certainly would want to have higher prices.
Yeah.
Now, the way it may cap the current market a little bit is by them, and we already have seen some signs through ship tracking that they might be actually exporting a little bit more than they're saying. So there's no reason why they shouldn't want to cash in these very, very high prices. The other reason, of course, yes, going back to what Clive says, is China. It's still quite murky, even though I do think I'm actually still positive about this market. I think we'll see probably $100 by the end of the year, one way or the other. The reason is that we've seen an uptick in property prices in China again. So even though this subprime Chinese subprime situation is not far from resolved, it's still it's still a problem. There could be a cap, but typically I remember trading in Asia for many, many years. This is the time of year when China buys a lot. They've got Golden Week now coming in, fuel demand is picking up, international and domestic demand is picking up for travel. At the same time, refineries are preparing to buy oil in anticipation of the Chinese New Year, of course, because of the big gaps, delivery and so on. So it's 2 to 3 months earlier. So this is a time of year, but generally you'll see demand very, very strong. So overall, I think I'm very positive about the market. So somewhere in between, I'm not probably quite as bullish as Omar, but at the same time, I see a lot of positives out there, including, Chinese industrial activity and the US economy ticking along very well in spite of all the politicians in the US trying to kill it.
Yeah. Well, just before I leave you, Ali, you mentioned that Saudi is probably exporting more than it's letting on. What about Russia? What's the latest sort of indicators out there, if you like, on Russia sticking to, or at least starting to implement some of the cuts it pledged earlier this year and more recently?
With Russia is always very difficult. Whether they are starting to implement or not is very hard, because to Russia, the most important issues for Putin rather than Russia are domestic issues. And they have a lot of problems with domestic supplies now. They just don't have enough domestic supplies. Hence, they've had this ban on diesel exports. And they can always juggle between crude and products, making it very hard to actually figure out exactly what they're doing. The other thing that happened that a lot of commentators forgot was that in the last few months, there were quite a few turnarounds in Russia. Almost 40%, some 40% of refining capacity was out. So that was another reason why that exacerbated their exports. But looking at a longer picture, there has been less export, but not as much as they claim. So not 500, but probably a couple of hundred less. But that I would not. I always say the same thing. Putin needs cash. Putin will export as much as he can, subject to circumstances.
Okay, Omar, just back to you, and let's talk a bit about products. Is it crude pulling products up, or inflation pulling crude up, or is it products pulling everything else up, if you like? The recovery in jet demand, recovery in gasoline. Europe, for the first time, we see wage inflation is above, wages are above inflation, if you like. Some stats coming out last week, and more expected. So, where's the pull and the push, if you like, do you think, in this equation today?
Well, I mean, it's interesting. So basically, OPEC is cutting production, so there's less oil. We hear a lot about, are they really going to do it? I mean, before the are they really going to implement the cuts? they're not going to implement the cuts, and they're just talking and they'll never do it and all this kind of stuff, right? Because they don't have enough quote unquote storage. Now, when the story came out about Russian diesel, we have the same thing. They're not going to do it. Obviously, it's a bluff. You've seen it on Reuters, on Bloomberg. Why? Because they don't have enough quote unquote storage, right? So I think that going into winter, one thing you don't want to be short is the oil market. Okay. Now, for whatever reason, China's going to do this and Europe's going to do that. I think basically being short oil is going to be a very gutsy play, right? So again, I think basically the market is set for higher. I think the market is set. I mean, what would surprise the market and commentators is basically if this market actually surges, if it does surge, because we keep hearing, I mean, you're mentioning inflation, right? But everybody's saying that inflation is peaked, we're coming off. Maybe you've got one more Fed rate rise and then they're going to cut. So that doesn't kind of gel with, inflation going higher, and that's the reason for crude going up. Crude went up when they were, when inflation numbers coming out of the US at least were going lower. So no, I don't believe that there is a correlation between inflation going higher and oil going higher. I think there's a bigger picture at play. I think basically there's not manipulation in the oil market, but there's basically certain vested interests. I think people just still don't understand that if you tell Saudi Arabia that in 10 years we're not going to need your oil, they're going to want to maximize revenue. I think that still has to enter basically the psyche of people.
And that's 10-year outlook. But as Adi said, the more up-to-date new piece of news is that budget revision of being in deficit for the next year or two or three in Saudi because of their huge, obviously, expenditure plans. That's obviously a choice that they're making, clearly, to continue that expenditure. Clyde, just back to you. Adi mentioned a bit about China, sounding quite positive. The property prices are recovering. I mean, I just keep on reading doomsday articles about the property sector in China. But is this sort of policy, is the government intervention, stimulus, actually kind of succeeding now in pushing that back a little bit? And obviously we've had other PMI data come out recently. I mean, in terms of how well really the economy is doing, relatively speaking, not too well, but Q4 expectations, growth expectations, back to sort of this year's normal?
Well, I think what we're seeing in China at the moment is there are parts of the economy that are actually doing pretty well. And quite frankly, that's not really captured by a lot of the media reporting on China. And you do tend to hear more about the sectors that aren't doing well. There are some minor, I would say, little green shoots in the property sector. You have seen, increased lending, which, goes towards an increase in demand for new apartments and things like that. So there are some things that are looking okay. If you look at the PMIs, if you look at the private sector one and the official one, they're basically telling a story of an economy bouncing along, at a kind of steady level, not accelerating, not really decelerating. So I think what you actually got in China is a reasonable economic picture. And, a reasonable economic picture when you're talking China is it translates into massive commodity demand. People really forget that. The people say, oh, China's a new Japan. Yeah, it may well become the new Japan, but it will be 10 times the size of the old Japan. So it's still going to be consuming massive amounts of commodities, even at a modest growth rate of 3-4% going forward. So I'm kind of still sort of quite bullish on the idea of China being a major commodity demand center for many years to come. And I think that is, you got to factor that in. I think what the Chinese are capable of doing is dialing up and down commodity demand in a way that they weren't in the past. In the past, they were growing 8, 9, 10%. They needed the commodities. They were going to pay the price no matter what. Now they've actually, they've got stockpiles. It's not just oil. They've got stockpiles of, copper, of aluminium, of steel, of other things, and they tend to be able to manipulate those. Where you see where they are less successful is when they don't have stockpiles. Like right now, the iron ore prices are $120 a ton. That's high by historic standards. the Chinese port stockpiles are at their lowest level in 3 years. Coal stockpiles, also not good. Coal prices have been rising, the Chinese have been demanding it. So I think their ability to change the market is really dependent upon the level of their stockpiles. Now, they don't talk about their crude stockpiles very much, but we have seen in the past when they deem that prices have risen too quickly or too high, they do tend to pull back on imports and they tend to use stockpiles. I see no reason to expect that that won't be the case again.
Okay, and what about their exports? We've had them obviously issue a couple of big, recently, especially in September, I think the second big export product quota. Some talk that they may not issue this third one, or they might pull back on the size of it. You know, what impact could that have on those product prices for the region?
Well, I think, I mean, you're basically got a squeeze in diesel because the barrels that have come out of the market from the Saudis and the Russians have predominantly been medium sour barrels, high distillate yield. Refiners are struggling to replace those. So if the Chinese are able to capture some of that strong margin for producing diesel at the moment, I suspect they're going to do it. Whether they import oil to do it or dip into their stockpiles remains another thing. But at the moment, we are seeing their exports of diesel rise. We're expecting that to continue this month in October. And for the Chinese, it's such an easy economic win. It really helps them boost their growth rate because their goal was refining capacity. They can run their refineries at 15 million barrels per day, and they can do all sorts of things, you know, to just boost economic growth quite quickly. And I expect that that's what we'll see in the in the quarter. Yes, I'm sorry. It's his dinner time, so he's coming to us for dinner.
Okay, we won't keep him waiting too much longer.
I'll put him down. Sorry
Don't worry about that. Great, Adi, back to you. Let's talk a bit about supply again, and the US. We don't really talk about the US much anymore in this program in terms of oil supply. You know, it's kind of like steady as she goes. You know, but again, I mean, we just had a comment on our chat here. Rigs down, the lowest since 2022, but production has been pretty steady this year, has been rising back up towards that 13 level, maybe not expected to go any further. Give us the recent sort of gossip in the market about where that's going in terms of US supply coming back in as other supplies cut.
If you would just allow me just to take one step back and mention something on China that we haven't mentioned yet, and then I'll come back to the US. Sure. One of the points that we have not mentioned yet was there's a massive petrochemical capacity coming online in China in this year and next year. It's absolutely massive. And that will result, even at low run rates, of even at half 50% or so run rates, that will result in additional demand for naphtha of like 500,000 barrels a day. So, you know, these things have to be taken into account as well. The other thing that China is, because of closures of all the refining in US and Europe, and new refining coming up in China and Asia in general, what now is happening is that pretty much we're kept, all the sort of global refining system is kept at ransom by China and their quota system. So if they allow exports of diesel cracks will come off. However, if they don't, diesel cracks will continue to roof. So actually China is very much globally in a position to dictate refinery cracks globally. So now back to the United States. I always laugh at people doom and gloom about shale. Yes, there's every week and monthly we get a few rigs down, but they seem to be hitting record production. Nevertheless. So what's going on? I guess they're just being far more productive. I do believe that the markets do work, and I do believe that I think US will be there to supply additional volumes if they can. Particularly now, what is very interesting here in Europe, Daila, is that because we've lost this OPEC sour crude, we've got record inflows of sour crude from the United States, which is Mars especially. So it's becoming a bit of a staple. So, that's kind of displacing some of the OPEC barrels. At the same time, let's not forget, from the OPEC side, even though the Saudis are really the only ones doing the hard work, It's now Iraq is actually hitting exports, record exports, in spite of the fact that Kurdistan is not exporting at all. So yes, it's not just the United States. I think we've seen record exports coming out of Canada. We're seeing record export coming out of Brazil, and everyone else is stepping up and taking advantage of these very, very high prices. And I think even the Saudi volumes that I forgot to mention when we talked about Saudi potential increase is that they had problems in the neutral zone with Khafji field. And that seems to have been sorted out. So we'll probably see very soon another 200,000 barrels coming out of neutral zone, additional supplies. So that's one of the reasons I'm not super bullish. I'm very positive this market. I think market structure and all the sort of paper side of things are pointing towards a very, very strong market. But, you know, longer term down the road, I think you know, there will be some moderating factors.
Yeah, I mean, next year everyone's saying more supply will come on board, and of course we'll start to see the demand effects of these high prices possibly. I'm going to go to Omar and talk a bit about gas outlook in a minute, but just look at the survey question there. The November contract expires on Friday, and we're now trading December. Is it too late for winter demand delivery to propel Brent to $100 a barrel? It's on its way there, yes or no? Is it too late to propel it to that $100? My question, or my other question would be, for example, you know, what could bring us back below $90 possibly? I might go to Omar with that later. But first, Omar, I want to ask you about gas outlook. Obviously, we're going into winter now. We've had Indian summers all over Europe, admittedly, but, you know, we could get some cold spikes anytime with this global warming, which we won't go into. But on my outlook for gas, it's been pretty steady this year. LNG prices are still a little bit high. You know, Asia probably has something to worry about going forward. But what's the outlook with that on that from sort of market participants, if you like?
Well, I mean, okay, so in terms of gas, the only gas that I look at is basically Henry Hub, which is like a futures market, which has nothing to do with the European TTF or with LNG prices. But it seems to me that we are on Henry Hub approaching a bottom. Now, whether that bottom is in, I think the market traded like just below $2 at some point, 194, something like that. But in any case, I think basically that you can make a good argument that that is actually the bottom, and now we have to take out new highs above like $9 or so. I mean, it's an interesting question. The thing is, again, it's to do with risk. So you can look at the market and you can look at it over like a 10-year period, and you can see that below that like 190, $2 kind of range, it's pointless. Where's it going to go to? Where it's going to go to like, you know, it's been up to 9, 12, something like that. So it's unlikely. You know, if I have some money and I wanted to bet on Henry Hub, I'm not going to say, yeah, you know what, it's trading at 2, maybe it'll go to 1, you know, and whatever. When I look at it and it has basically upside potential up to 9 or 12, doesn't exactly make me excited to want to short energy. The other thing I think is that consensus always is a great factor. So everybody is talking about, you know, the Fed has maybe 1 or 2 interest rate cuts, interest rate rises, and then basically they start cutting. Everybody's saying like a recession is coming. You know, I read Bloomberg every day. They say probability of recession is now 100%. Our model shows 100%. They've been saying that for about 6 to 8 months, right? All the time. And what gets me is that the market is all set for that. So I like the idea that something comes and disrupts it and make all these people that think that inflation is done and you know, we're coming off and it's deflationary and all that kind of stuff, that they are completely wrong. And basically that we've got higher rates to come. And the fact that it's very interesting, but maybe for you know, if they cut, if interest rates stay at 5% and debt is at 33 trillion. They have to pay about $1.5 trillion just on coupon payments, right? And deficits increasing by 1.5 trillion a year. So when you print that kind of money to distribute, just to service your debt, is that inflationary? I would say yes. So what if you get into like a vicious cycle where rates keep going higher because inflation keeps going higher? They keep putting more and more money in the market, printing more and more, which is basically the whole idea of dollar going the other way, because everybody's now bullish on the dollar. So dollar tanking and commodities roofing. So I like that kind of idea. I'm not enamored with recession is coming and it's only a question of time and they're going to start cutting rates and it's deflationary and all that kind of stuff. I think consensus is not a good place to be if you want to make money.
Okay, Clyde, let's talk a little bit about sort of the rest of Asia. We talked a bit about China. In terms of demand, Indian economy is still ticking along nicely. We saw some news, we had it on the bulletin today about it now coming back into the market, taking on more Russian oil, more than it did in August. Perhaps that's something to do with their refinery turnarounds. But again, how much support is India giving? And just give us your take on other East Asian, if you like, and South Asian consumers, the impact of these higher oil prices on them going forward in Q4. Will that have any impact?
Well, India is the bright spot of Asia at the moment. The growth is very strong there. You're seeing that. You have seen oil imports rise quite strongly. Yes, they're buying as much as they possibly can from Russia. Russia's meeting almost 40% of what they're buying at the moment. The discount on the Russian barrels is narrowing, but it's still cheaper for them, so they're going to continue with that trade. I think the risk is always that high oil prices in themselves cure high oil prices, because eventually they crunch demand. India is now got its consumers are exposed to high oil prices. They get passed through to the retail price at the petrol pump quite quickly. So I would imagine that we are starting to see little bits of evidence coming through that the consumers are starting to feel pressured again across Asia. High energy prices cut confidence. They cut spending. They raise the possibility of higher interest rates, even as central banks do stand pat. But they certainly it makes interest rate cuts look further away, and it keeps people front and center worried about inflation. And if you just look at Asian media, the local media in each of the various countries, Thailand, Malaysia, that kind of stuff, then you actually see that the wall of worry is starting to be climbed again. And I think that kind of puts a little bit of a question mark over how high oil can go.
Okay, we see this, our survey result that 60% think it's not too late to propel Brent to $100. Last week, our surveys, 40% of our audience said that 90 would be more likely. The majority said that 90 rather than 100 for the rest of the quarter. So, I mean, it seems to be sort of averaging out there, give or take. Adi, let me just go back to you, maybe just to wrap up very quickly for us, because we started a couple of minutes late. We had a bit of a comment earlier on how wages now are beginning to catch up with inflation as things stand. Let's see what happens. But again, I did mention the sort of slightly sort of more positive news out of the UK and Europe, that's now beginning to happen. What's the current mood in the UK now? Energy prices, etc. We had a disastrous winter last year with high energy prices, etc. A little bit of comfort going into this winter?
There's definitely a lot more comfort going into this winter, simply because the stocks are so high. I mean, European stocks are very, very full. Actually, UK has been exporting quite a bit of gas into Europe. The way it happens is because UK's got so much regas capacity, so they import LNG and then they export gas via pipelines to Europe. So mood is a lot more positive. We have lovely warm weather here still, as you mentioned earlier. I think the key, the mood is very positive in that respect, but and prices are relatively low, especially compared to last year. I think the question is, again, what kind of winter we are going to have, and obviously that we have no idea. So if we do get another cold winter, I think the situation would be pretty dire again. But as Clyde said, I think the best cure for high prices are high prices, and I think we definitely see quite a bit more. Europe's been amazing in terms of the sheer percentage of demand cuts. either through industry, processing less the high sort of energy intensive industries, but also consumers using quite a lot less gas. So we've lost about 10-15% of demand, which is quite, I will use that horrible word, unprecedented. So
Okay, and it's also obviously going to
overall, yeah, the situation is looking a lot more positive at the moment.
Yeah, but still likely to see some impact on other consumer spending as well, of course, which all feeds into the inflationary argument and how far that might go. Okay, well, thank you, gentlemen. I'm afraid we run out of time. Thanks to Adim Sirovic, Amar Najia, and Clyde Russell for joining us this morning, and have a great week ahead.
All the best.
Thanks, everyone.
Bye-bye.
Thank you.